Today I wanted to talk about our Australian dollar forecasts. Recently we released our monthly June market outlook, and we've increased our forecast for the Australian dollar from 68 cents to 72 cents by the end of this year and to 76 cents by the end of 2021. So why have we done that? Well, we certainly have to recognise that over the last month the Aussie dollar has been on quite a tear. It's lifted from 65 cents up until late last week. It was up at 70 cents, came back down to 68 cents, now settling as we speak today at around 69 cents. One of the important factors has been the iron ore price. You know, there have been two factors behind that, the 25% rise in the iron ore price over the last month or so. Firstly, the impact on supply of iron ore from the COVID-related problems that Brazil has been having. And secondly, the increase in demand that's been associated with China's boost to their construction cycle, both in housing and in infrastructure. In fact, I look at China and I think it looks as if they're trying to generate 12 months construction activity in 9 months, given they lost that first quarter through the COVID crisis. I'm also not very confident that the Brazilians are committed to dealing with their issues, and so we think those supply constraints and those demand boosts are going to be around with us for the rest of this year, and that's going to maintain a strongly supportive iron ore price for the Aussie dollar. But the other story, of course, is around the strength of the Australian economy. Now, I know we're talking about a deep recession, but we have seen that extraordinary rebound in consumer sentiment. So over March and April, consumer sentiment, as measured by the Westpac index, fell by 20%. But in May, it lifted by 16.4%, and then again in June by another 6%, meaning that we've basically recovered all the 20% loss that we had in confidence. That's also led us to talk about a more shallow recession than we had been expecting before. So for instance, Westpac is now expecting that the June quarter, the economy contract by 7%, whereas before we were looking at about 8.5%. So confidence around Australia, confidence in dealing with the virus, confidence in opening up the economy earlier than expected, I think has also provided a boost to the Australian dollar. But of course the third big factor is risk, and the Australian dollar, being a risk-related currency, is always going to be impacted by sentiment around risk. Obviously risk took a huge hit during February and March and into April with the collapse in the global economic outlook associated with the COVID crisis. But central banks and governments came to the rescue, in particular the US Federal Reserve. They're likely to increase the size of their balance sheet from $4 trillion around February to up to $10 trillion by the time we see the end of this process over the next 6 months or so. And they've said they'll effectively do whatever it takes. So they're buying corporate bonds, they're lending money to small business, they're investing in syndicated loans, and of course they're buying US treasuries and buying asset-backed securities. And I think we've seen from the Fed, even in the last few days, this commitment to doing what is necessary to maintain liquidity and confidence in the US economy. I don't think we're going to see that going to reverse at all between now and the end of the year. So that's why we're expecting that the Aussie dollar, that's now at 69 cents, with the iron ore price, with the confidence in the economy, and with the ongoing risk story, it'll lift to 72 cents by the end of the year. But think about that 72 cents. That's only 3 cents away from where we are today. And yet over the last couple of months, the Aussie's lifted by 12 cents. And the reason why the pace of recovery is going to be a lot slower is that we are going to see backward steps in terms of this risk environment. We've seen hospital admissions in the southern states of the US rising. We continue to see ongoing concerns about the impact of the virus in the developing world, and there continues to be talk about a second wave during the northern winter. So markets are going to remain tentative, and there are going to be times when risk will have reversals. But we think the general feeling around risk, given the commitment of governments and given the fact that economies will be gradually mending, that the risk positives environment will remain the dominant factor. And that's why we're expecting to see that Aussie dollar higher, 72 cents by the end of the year. Next year, we've always argued that next year was going to be a risk-on year. The global economy would be turning around. We're expecting the global economy to be growing by 5% next year compared to the 3% contraction we're looking at this year. And that'll include stories like 10% growth in China. So we're confident about a further lift in the Aussie dollar, but it'll be lifting from that 72 base rather than the 68 base that we had before. So we'll finish the year at 76 cents. That's around the average that the currency has held since the industrialization of China back in the early part of this century, when the commodity prices started to take off. The economy generally doesn't handle that level of the currency particularly well. And bear in mind that the Reserve Bank's current forecasts are that the Aussie dollar will average 64 cents over its forecast period. And the unemployment rate will still be at 6.5% by the middle of 2022. The environment I've described does indeed suggest that it's possible that the Aussie dollar could be even stronger next year. And that will create challenges for the Reserve Bank, particularly if the recovery in the economy that we're expecting will be slower, and that if that unemployment rate at 6.5 is a bit higher. So what I'm saying is that I've argued in previous talks that the Australian economy would benefit better than most other economies from the perspective of negative interest rates, because we're a small open economy and the currency would be very vulnerable to negative rates. So let's not close off that debate just now, even though the Reserve Bank has argued that negative rates are extraordinarily unlikely, because that environment of a very strong Aussie dollar and some disappointments in the pace of recovery next year may indeed put negative interest rates back onto the policy debate. Thank you.